Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market, and in this video I want to talk about the different kinds of markets that you can trade. So there are 5 main kinds of market that you're going to look at trading. You might be interested in trading stocks or shares. You might want to trade the stock indices. You might want to trade commodities. Perhaps you want to get into currencies, or the newcomer on the block, cryptocurrencies. And we're going to take a look at all 5 of these different kinds of markets, and within those 5 you're going to find plenty of different opportunities to trade. So we'll start out with stocks or shares. And by the way, stock and share means the same thing. So you might hear some people refer to them as stocks, others will refer to them as shares. But most traders start here, normally because perhaps they work at a company and that company is listed on the stock exchange. So maybe they find themselves with some shares, or they hear stocks or shares on the news every night. So they're a little bit more comfortable or familiar with stocks or shares. Or maybe they feel that stocks or shares might be a little bit easier than trading, say, commodity futures or cryptocurrencies. So the reality is, once you know how to trade, you can trade any of these instruments without any difficulty. And trading a stock is no harder or easier than trading a currency. But for whatever reason, most traders start out here, and that's completely fine. There are plenty of great examples, plenty of great opportunities out there if you want to trade shares. When you're trading a share, you're buying a percentage or a share of a business. So think about McDonald's restaurants, for example. The entire McDonald's corporation is listed on the New York Stock Exchange, and it's worth about $120 billion as I record this video. Not too many people in the world can afford to fork out $120 billion to own all of McDonald's. So the reality is McDonald's is owned by a number of people. You've got small individual traders, you've got companies, you've probably got pension funds and superannuation funds owning bits and pieces of McDonald's as well. So you're dealing with a percentage or a share of a business. Shares are traded on stock exchanges all over the world. So you've got shares in Europe, the US, the United Kingdom, Australia, Asia. You've got different exchanges all over the world. So if you're living in Australia, for example, and you can't find any good shares to trade in Australia, which is probably going to be fairly rare occurrence, but assuming you can't find something you want to trade, you've got plenty of shares at your doorstep all around the world. With technology, it's very easy to trade a share in so many different countries. So we're going to look at a few charts as examples. We're going to look at Apple, which trades on the NASDAQ exchange in the United States. We're going to look at McDonald's, which trades on the New York Stock Exchange, also in the United States. And you can see there that they're both American shares, but they trade on 2 different exchanges. So the New York Stock Exchange obviously is McDonald's. MCD is the McDonald's code, and the .NYSE means that it trades on the New York Stock Exchange. And then Apple, .NASD. AAPL is the Apple code, and NASD stands for, or is short for NASDAQ, which is where Apple trades. Then, of course, in Australia, we've got a stock like BHP Billiton, which actually trades on 2 exchanges. It's got a dual listing. So if you're trading BHP, you'll want to pay attention to what's happening on BHP, both on its Australian listing, bhp.asx, the Australian Stock Exchange, or BLT.LSE. So LSE is the London Stock Exchange. So let's have a look at some charts now. Here's a chart of Apple shares, and probably no surprise to you that you can see across the chart over the last decade or so, you've basically seen a really big up movement. Apple's multiplied its price by about tenfold. So down around $20 per share early on, now up over $200 per share. So more than 10 times its value in that point. Don't be sucked into thinking, oh, that's all there is to it. I just buy Apple shares and they go up. The reality is you need to look at as much history of markets as you can. Not necessarily Apple, which may not have been around as long as some other markets, but keep in mind that if you look at something like the Dow Jones Index, which in Profit Source, which is the software that I'm using here, we have more than 100 years worth of data on the Dow Jones Index. You'll see that stocks don't do this all the time. There are periods where markets run up really strongly, as Apple has done here. There are periods when they run down really strongly, and there are also periods where they don't do much for a long period of time. All right, so that's why it's important to be able to determine the trend of the market before you jump in and try to trade something. Even within Apple shares, even within this large bull market, pay attention to the fact that there have been some significant pullbacks. Okay, Apple lost around half its value through there. You've gone from about $100 per share to $60 per share. That's a loss of 40% of its value in this period here in 2012 to 2013. And another big fall here from about $140 per share to about $85 per share. All right, so you can, even within a large bull market or large up move like this, get some pullbacks as well. So it's important before you jump into any stock or any commodity to have a trading plan and to have an idea of how far a market has already gone and how much further you think it might go. So there you go, there's Apple shares. Another example, McDonald's shares. If you like your McDonald's and you want a piece in their profits, you might decide to buy McDonald's shares or trade in McDonald's shares. Again though, it's very interesting. You can see McDonald's has had a really large run up from the early 90s up until now as I record this. So over the last nearly 30 years, particularly the last 15 years since this low here in 2003, McDonald's has shot straight up. However, there have been years such as this period through here in 2013 to 2015 where the price really didn't do a lot and McDonald's was just going sideways. And during periods like this, people often get itchy fingers and they think, oh, I want to trade something that's making more money. So they might get rid of their McDonald's shares and go and trade something else. So you have to decide what kind of trader you are and how long you want to hold your shares before you decide what kind of market you want to trade. So there's McDonald's. Another interesting thing to note is that it doesn't look like it. You might look at this chart and say, wow, it's just all been straight up. But if you'd bought McDonald's shares in 1999, over the next 3.5 years, they actually lost 75% of their value. So if you'd bought $10,000 worth of McDonald's shares here in 1999, in 2003, they were worth $2,500. So about 75% of their value gone. All right, so again, take the time to study as many charts as you can. If I can give you one piece of advice, if you're new to trading, it's look at as many charts as you can. The news channels, the financial news, they all focus on what's happening right now. Oh, the market's shot up by 2 or 3% today, or the market's shot down, or and they'll overemphasize what's going on. It will be over optimistic or over pessimistic because they're trying to sell news, okay? But in reality, most of the time, most days, it's just a really small move in a very long history of a market, all right? So we've looked at two different stocks. We've looked at Apple and McDonald's, and if we had just stopped our analysis there, you might look at those and think, oh, wow, stocks always go up. Stocks are great. I'm going to trade stocks, okay? Here's another example of a stock. Here's BHP shares. So over the same period of the last 10 or 11 years, while Apple and McDonald's have been roaring up, BHP's effectively gone sideways, okay? Now, that doesn't mean that one stock is better than another. It just means they're in different parts of their cycles. So again, you really need to pay attention to what the trend of the market is, both on the big picture and on the little picture. All right, so we've had a bit of a look at stocks. Next, we're going to talk about stock indices. And a stock index is just a number that represents a group of stocks. It's an average. So for example, you might have the ASX 200 here in Australia, which we're going to talk about. And that's an average price for the top 200 stocks in Australia. So the index, by the way, you might hear an index referred to as an index. Index or indice, they both mean exactly the same thing. And they're interchangeable. You'll often hear traders, and I probably do it myself, you'll flick between indice and index. They just mean the same thing, okay? But an indice will give you an idea or help you to gauge the strength of a particular group of stocks. So if you've got the ASX 200 and it's moving up or trending up, it means that in general, the Australian share market is trending up. Now, that doesn't mean that every share in there is going to go up, but it means that in general, on average, the Australian share market is going up, okay? Now, indices don't actually exist. You can go and buy a share and you own a percentage of a company, but you can't go out and buy a percentage of an indice or an index, okay? You have to actually trade them using a trading instrument or a trading vehicle, and a common one that people use to do that are futures contracts. Now, futures contracts are a little bit beyond the scope of this video. If you're a safety in the market student, you've got all the information that you need to trade futures contracts in Appendix B of your Smarter Starter Pack, which is the first half of your Active Trader program, okay? Now, some examples of indices, you've got the S&P 500 in the United States. That's the top 500 stocks in the United States. You've also got the NASDAQ index in the United States, which deals exclusively with technology-based stocks, Okay, we're going to look at some charts of these as well. In London, you've got the FTSE 100, the top 100 stocks there. And in Australia, we've got the ASX 200. Now, let's take a look at some of these different charts. Firstly, the S&P 500. So this is an average of the top 500 stocks. And you can see that since the lows in 2009, down under 700 points, the S&P 500 has run up to over 2,900 points at the time of filming. Okay, so it's starting to get close to 5 times its value from the low, and that's a huge rise over that period. Again, if you go back and study the long-term history of markets, these sort of runs, they can go a lot further than people think, but they don't go forever. Okay, so again, don't be sucked into thinking, oh gee, this is going to go up forever, I can make lots of money, I'll just start buying today and it'll go up 5 times again in the next 10 years. All right, markets have up times and they have down times. You just have to cast your eye a little bit further back on the chart, and you can see some pretty savage sell-offs there. That was 2007 to 2009, where the index lost more than half of its value. All right, so again, be a little bit cautious there. Similarly, the NASDAQ index in the United States, the technology stocks, it's had a really good, strong run up as well from its 2002 lows. If you cast your mind back, some of you may be a little bit young to remember this, but cast your mind back to the year 2000, and we had what's known as the tech wreck, when technology stocks completely fell out of bed. So in the 1990s, the concept of the internet, and certainly YouTube, where you're watching this video now, was a pipe dream. It was all, no one really knew what it was all about, but everyone knew, in inverted commas, everyone knew that technology stocks were going to make a ton of money. So everyone was just buying all these stocks that weren't really making money. The prices ran up to insane levels, insane for the time, around 4,800. And then people sort of calmed down a little bit and realized, hang on a minute, these companies that we're buying aren't making any money. A lot of them are losing money or going broke. So all of a sudden people changed their mind and panicked, and the technology index or technology stocks fell out of favor, and no one wanted them. Everyone became pessimistic, and the price actually fell from 4,800 all the way down to 800 or 797.50 on this E-mini NASDAQ futures contract. Okay, so it gives you a little bit of a glimpse of how markets work. Firstly, just because an idea is good, think about how good technology is today and how good the internet is today. Well, that's all fantastic. People had that idea back here, but it was a little bit early. So the idea was right, but it was a little bit early. Secondly, look at how people change their minds. Market ran up because technology is the greatest thing in the world. Market collapsed because technology is the worst thing in the world. Not the worst thing, but they didn't see the value in it. Okay, and then it slowly found its footing and slowly worked up, and now it's taken off again, and up we go. Okay, and that's why I like to take a technical approach to trading, where we look at charts and we look at trends and we look at price forecasting, instead of, say, a fundamental approach, where we look at the basic fundamentals or value of the business. Because you can have a really good business idea, but it may not be worth money for 5 or 10 years. All right, so technical analysis really helps you with your timing of these sorts of trades and waiting until the move gets started until you get on board. So there's the S&P and the NASDAQ, and you might think the last 10 years or 15 years have been terrific times for global indices if you just look at the two indices. But let's have a look at the FTSE 100 in London. Okay, now it's had a run up as well, but can you see that it hasn't been as easy a run as the S&P 500? It's still taken out its 2008 tops, but not by as much. It hasn't rocketed up in such a straight line as the S&P 500 has. Okay, so it's been a weaker run on the FTSE 100. So what that's telling you during this time is that the US stock markets have been performing a lot more strongly than the London stock market or the FTSE 100. Okay, even the trends or the shape of the market, you can see there's a lot more choppy sideways action through here, and again, even up here a little bit as well, as opposed to the nice clean trends on the S&P 500. Another one we'll look at, the ASX 200. It's been sort of similar compared to the FTSE. It's actually a little bit weaker than the FTSE because it hasn't been able to take out its 2007 high before the bear market. Okay, so it's in a much weaker position, or has performed a lot more weakly. So again, stock indices are a great vehicle to trade. Rather than worrying about one stock, and maybe you buy one stock and that stock has bad earnings, but all the other stocks go up. Stock indices give you an average. You're trading an average you're not going to be as affected by one bad stock announcement. Okay. David Bowden, the founder of Safety in the Market, he predominantly traded two things, the currencies and the stock indices, and he was most famous for his forecasts on the SPY 200 futures contract, which is the futures contract over the ASX 200. It used to be over the All Ordinaries Index, now it's over the ASX 200. But David's forecasts that were for the 1987 top before the crash and the 1989 top, for example, among many of his forecasts, but the 89 top was done a year in advance. This is the market that it was done on, okay, the Australian share market. All right. Now, we've looked at stocks, we've looked at stock indices. Let's talk about some commodities. Commodities are a physical product, not a share. So it's a physical product that's going to potentially be consumed. You're not actually buying ownership in something. All right. And they're often traded using futures contracts, much like the stock indices. There are other vehicles out there for trading stock indices and commodities, such as contracts for difference and options. And again, if you're a Safety in the Market student, just check the appendixes in the Smarter Starter Pack, and you'll be able to find all your information on how to trade those. Okay, but they're often traded using futures contracts. Now, they can be extremely volatile, and I'm going to show you some charts so you'll see what I mean in a moment. Some people will shy away from that and say, oh, volatility, I don't think I can handle that, and that's completely fine. If you're a little bit scared or a little bit hesitant to get into those, don't start there. Maybe start trading something a little bit less volatile first. Okay. Other traders, on the other hand, will look at it and say, well, if it can be extremely volatile, it can be extremely profitable. Okay, and they'll jump in there and take advantage of the volatility where they can. All right, so it's always two sides to the coin here. And part of choosing a market to trade is choosing something that's going to suit your personality. There's no point getting into trading and starting to trade commodities if it's going to stress you out and ruin your life because you can't eat or sleep because you're stressed about commodity markets. Okay, on the other hand, if you can handle all of that and you're excited about it, well, maybe commodities are for you. And again, that's why I encourage you to grab a piece of charting software and go back over as many charts as you can, look at as much history on as many markets as you can, and find the markets that are going to suit your personality. So some commodities that you might like to trade, you've got the gold market, you've got oil, crude oil futures, you've got coffee as well. Now, there are millions of these that you can trade, probably not millions, but hundreds that you can trade. I'm just going to take you through three of these. So here's a chart of gold, and you can see that gold had a long sideways period through here up until early 2000s, and then bang, it really took off, and it really accelerated as stock markets were collapsing during this period, or during the bear market of 2008, 2009. We had what's called a flight to safety, and gold is one of those safer commodities where people think, well, at least I've got gold, it's going to have a value. If the US dollar collapses or the euro collapses, at least I'll have some physical gold to hang on to. So obviously the price of gold went up during that period, right? And now it's been pulling back a little bit since there. You can see that when gold is on the move, it tends to make really good trends, and it is quite they're quite exponential moves as well, as you can see there. When it's not moving, like most other things, a little bit less exciting to trade there. So you tend to get two extremes with commodities. It's either going at 100 miles an hour or it's driving at 5 kilometers an hour in the slow lane. All right. So there you go. It's a little bit of a sideways run at the moment, stuck in a little bit of a range there, a few $100 range there. But again, take a look at the chart. Is that something that you think you would like to trade? Here's another example, the oil market. And with crude oil, it's interesting when you hear people talk about this. There always seems to be a million opinions, which is fine, particularly in this age when anyone can express their opinion very easily on YouTube or in any online social media platform. With crude oil, in this run up to the July 2008 high, there was a lot of talk about scarcity of oil. So will we run out of oil? And if there's a war, that's going to affect the availability of oil for us to use and drive in our cars. So the price of oil went up because of a scarcity mentality. All right, and obviously later it collapsed, as markets often do after a bubble. And you start hearing other stories. People will say, "Oh, but we're all going to start using electric cars. No one's going to need oil. We're going to be using green energy." So the price comes down. It's, studying markets is such a fascinating study of human psychology and investor sentiment. And again, you can learn a lot just by looking at charts. And just because something is logical and makes sense doesn't mean it's going to work in the markets. If you think, oh, we're going to run out of oil, so the price will go up. Maybe the price will go up for a while. But again, it doesn't take much for investor psychology to turn around, and the market can run all the way back down there. Now, look at this huge run up from about $45 up to $140, and then all the way back down even lower. That's happened over just a couple of years in the market, just a few years worth of trading action there. And I can tell you that the actual fundamentals didn't change that much in that time, that the price should go all the way up and all the way down. And again, that's why I think as a trader, particularly in this day and age, in this environment, when we have a 24-hour news cycle, I think technical analysis is your friend. It's going to help you identify these sorts of trends and protect you with stop losses, rather than just trying to pick the actual direction of it. See, as technical traders, we don't really care which way the market's going to go, because we can make money buying and we can make money selling or going short. And again, in the appendices of your Smarter Starter Pack, if you're a safety in the market student, you'll learn all about short selling in there if you want to know how to make money as a market is falling. All right, but there's the oil market. The third commodity I want to look at, which is a little bit more volatile, is coffee. So if you're someone who enjoys a morning coffee, you might be interested in checking the coffee price and wondering, is my cup of coffee next week going to be more expensive or less expensive than it was this week? Okay, but you can see over the last several decades, coffee has made a number of spike highs, up around the 300-cent level, and then generally speaking has come crashing back down to lows afterwards. And at the moment, you can see coffee has been in a bit of a downtrend here. Coming down, it's now made 3 bottoms around this 100 level. It'll be very interesting to see where coffee goes from here. All right, but you can see there, compared to, say, Apple or McDonald's, which made nice, strong uptrends, they were very bullish uptrends. These are wild uptrends. They're much more volatile. You didn't see anything like this. This is a near vertical line on coffee, and we didn't see that on Apple. All right, but again, the laws of gravity, sometimes, well, the laws of gravity, what goes up must come down. So often in the markets, you'll see a huge spike up like this, only for it to come crashing back down at some point as well. So again, this is why it's good to look back over a lot of history. This chart, which is from Profit Source Software, you can see back 30 or 40 or 50 years on all of the different commodities, and you can see what they've done in the past and get a bit of a sense for how you would like to trade them and whether you can make money out of those markets and whether you can sleep at night trading these markets. Okay, so there you go. There's the coffee market. All right, so that brings us to currencies now. And when you're trading currencies, you're actually trading an exchange rate between 2 different currencies. So there are always 2 currencies in a transaction when you're doing a currency trade. So if you go and buy Apple shares, you're really buying, you're buying shares in Apple and then you're selling shares in Apple. But when you're trading a currency, if you're buying, say, the Australian dollar, you're trading the Australian dollar against another currency like the US dollar. All right, so when I started out, when I was a student, when I was a brand new trader, I thought currencies were so hard. I thought, I can't get my head around this. There's the 2 numbers. Why are there 4 decimal places? How do you work it out? In actual fact, they're quite easy to trade. It's a little difficult to get your head around initially, but it's really not as hard as you think. And when I finally took a currency trade, I thought, oh, is that all that there is to it? Okay. The reason these days that I trade currencies almost predominantly is that currencies trend very well. Almost exclusively is the word I was looking for, not predominantly, almost exclusively. Currencies trend very well. They're also extremely liquid. Okay. Now, there's a few different examples or a few different charts I'm going to show you. I'm going to show you the euro, I'm going to show you the Japanese yen, I'm going to show you the Australian dollar, and I'm going to show you the Indian rupee. Now, before you start thinking, hang on, what about the US dollar? That's the world's most dominant currency at the moment, or the world's reserve currency at the moment. Why haven't you shown me the US dollar? Well, all of these currencies, remember, there are 2 currencies in a transaction. These charts, these are all traded against the US dollar. So I'm going to show you the euro traded against the US dollar. I'm going to show you the Japanese yen traded against the US dollar. I'm going to show you the Australian dollar traded against the US dollar. Okay, so let's look at some charts. Here's the euro. This is the euro futures contract, but this is the euro traded against the US dollar. So this price on the right-hand side tells you how much 1 euro is worth in terms of US dollars. So at the tops in 2008 up here, 1 euro bought 1.6 US dollars. Okay, obviously the euro has collapsed. These days it's buying between 115 and 120 US dollars as I record this video. Now, an interesting thing to learn from here. Firstly, look at the trends on this market. It trends quite consistently. Okay, the euro against the US dollar. You have little periods of sideways movement, but they're usually followed by good, strong trends. Okay, so it's often a good idea, if you're not sure what the trend is on the euro, just sit back and watch it, wait for the trend to declare itself, and then get on board that trend. So for example, we had a big crash here in 2014 into the 2015 lows. We had some sideways movement for a couple of years, which was quite a long sideways movement for the euro, but then it was back to its usual tricks and just trending nice and strongly through there. A great market to trade if you like trend trading. Interesting point or interesting takeaway from this, during this period of 2008 to 2009, look at the price of the euro. It shot down, it shot up, 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 okay? During that period, if you cast your minds back of 2008, 2009, the United States had problems, Europe had problems, and it was like people couldn't decide which one was worse. And for a while, for several months at a time, all the news would be about the problems in Europe, okay? So the European sovereign debt crises, all the stuff going on there, and so the euro would fall. But then the focus would shift, and all we'd hear is, oh, the US, things are going bad, with the currency there, the economy there, there's real trouble. The quantitative easing is really going to devalue the currency. So all of a sudden, people would say, oh, we oversold the euro, let's buy it all back. So they buy the euro. Remember, if the euro is going down, it means that it's going down against the US dollar, which means the US dollar is getting stronger against the euro. And if the euro US dollar price is going up, it means the euro is getting stronger in terms of US dollars. Okay, so as the sentiment sort of shifted back and forth, the price jumped up and jumped down and jumped back up again. Right? Again, a really good study in investor psychology, and it makes you think. Sometimes we sit back and think, oh, the experts have this all under control. Not always the case. Sometimes people just don't know which way it's going to go. But either way, as technical traders, we're not so much invested into which way the market's going to go. As long as it moves, we can make money from the trend. Okay. So there's the euro. This is the US dollar against the Japanese yen. Not too much different from the euro. Great trends. You can see there. It's generally moving. You have to really look hard to find sideways periods where the market wasn't trending. And then, again, bang, it's off trading again, off trending again. It's moving quite nicely. So as I said, currencies do tend to trend very well. Here's the Australian dollar. It is one of the major currencies, but it's probably on the lower scale. When you talk about the major currencies, you're talking the euro, the Japanese yen, the pound, the Canadian dollar, the Swiss franc, and the Australian dollar. Australian dollar, not quite as big, obviously, or as heavily traded as, say, the euro and the yen, but it is still quite a major currency. It's seen as a little bit of a risk play. It's a little bit more of an emerging market, but with a bit more safety than some of the other emerging markets. So people often like, if they want to add a little bit of risk to their portfolio, they'll trade Australian dollars, add the Australian dollar price in there. Not as clean in terms of the trends as, say, the euro is, but generally speaking, again, it is generally moving one way or the other. We had a little bit of a sideways run there, a little bit of sideways at the top there, a little bit of sideways through here as well. Okay, but again, another example of a nicely trending currency. The last one I want to look at is the Indian rupee, and you can see it's slightly less liquid than the other currencies, but it's still a very good currency to trade because of the large ranges that it makes. You can see some very large trends there, and it's basically moving. It's moving all the time, as you can see. So again, as traders, as long as we protect ourselves using stop loss orders, so that if we're wrong, we're taken out for a small loss, and then we let our profits run when we're right, so that we can make large profits. Large profits and some small losses is the recipe for successful trading. So again, all you're looking for is a market that moves and that moves as cleanly as possible. So there you go. We've seen a few different currencies there. By this stage, you should have seen something that tickles your fancy, or that you think, yeah, I'd like to trade that. If not, start looking. If you're thinking, oh, I don't really want to trade Apple or McDonald's, start looking at some other stocks. If you maybe you live in Germany, for example, and you're thinking, I don't want to trade the FTSE or the S&P 500 in America. I want to trade the DAX index. Well, start looking at that stock index. All right, but I'm just giving you some ideas here, and some pros and cons of trading these different kinds of markets. But you should have an idea of something that you'd like to trade by now. And if you've never traded before, I would strongly encourage you to choose your first market that you're going to trade, or your first instrument to trade out of these first four that we've looked at, because now we're going to talk about cryptocurrencies. And cryptocurrencies are the new kid on the block, and they're extremely volatile. They were front page news for a while during the Bitcoin boom in the back end of 2017. You'll see a chart of that in a moment, but they are extraordinarily volatile. They are more volatile than commodities, as you'll see in a minute in terms of the chart. Not for the faint-hearted. And again, if you've never traded before, I wouldn't recommend starting with cryptocurrencies. I'd learn the craft on one of the other instruments, like stocks or currencies, for example. Okay. We're going to look at Bitcoin. There's well over 1,000 different cryptocurrencies that you can trade, but there's really only a few that you might, that are really big enough to trade. You can invest in all of them if you think, I'll just buy some and hold it as an investment. But if you want liquidity and to be able to get in and out of your positions, Bitcoin's probably your best bet at this point as I record this, to jump in and look to trade. So there's the Bitcoin chart, and you can see that it's actually, it looks like it had a bit of a slow start, but actually these were quite massive moves as well. It's just the chart scaling that causes this area to look flat. Bitcoin actually started trading, at 1 cent per Bitcoin, or even less than 1 cent per Bitcoin from memory. And as of late 2017 or early 2018, it was up at 19,000. So do the maths there. Imagine you bought Bitcoin. Let's just say you bought $100 worth of Bitcoin at 1 cent each, and you sold them all at 19,000. It's a lot of money. It's more than most people can count. You would find very few people actually sold or bought right at the bottom and sold right at the top. However, as Bitcoin was going ballistic through this time, in these last 2 months of 2017, the price went from 5,000 up to almost 20,000 in 2 months. It multiplied in value 4 times. During that time, that's when all the stories were coming out. Oh, this trader, bought $100 worth of Bitcoin at 1 cent each, and now they're a multi-millionaire or even a billionaire. Okay, and people got caught up in the story, and they thought, yeah, I want to get in on this. And that's how booms happen in stock markets. It's a fear of missing out. FOMO, fear of missing out. They jump in there and they say, oh, I better buy before the price goes up to $1 million. I'll buy it here at 19,000. I'll hold up to 100,000 or $1 million. Okay, but again, this is where a study of history is important. You can see it's an exponential move. It wasn't going to go up forever. Well, look, it may have gone up forever, but if you look back over hundreds of years of history, there have been all sorts of booms. There was even a boom with tulips a few hundred years ago. Tulips, just flowers. Anyway, booms, prices go up. People think it'll last forever, and then they crash and they come all the way back down. Okay. Now, Bitcoin may have been the odd one out. Maybe it's the one that's going to go up forever. Okay, but it hasn't happened in this case. And Bitcoin actually lost about 70% of its value from that high in 7 weeks. Okay, remember it took McDonald's 3.5 years during its bear run from 99 to the year 2003. It took McDonald's 3.5 years to drop 70% of its value. Bitcoin did that in 7 weeks. Okay, so it's not just extremely volatile, it's phenomenally volatile. All right, so again, if you're just starting out and trading, probably not the one that you want to jump in and trade. And as you can see, it's been hovering for most of 2018 in a much smaller range down here. When we say smaller range, $6,000 to $9,000 is a pretty large range, but compared to what it's done previously, it's quite a small range. So where should you start then? Well, I'd suggest choosing one instrument and one instrument only. And the reason is that when you come into trading, if you've never traded before, there are 2 different things that you have to learn. You have to learn how to actually physically trade these, so the mechanics of it. So how do I trade shares? How do I open a brokerage account? How do I trades, how do I buy and sell and do all of that? Or if I'm trading futures, what is a futures contract? How do I trade them? How do I deal with expiry dates and all these sorts of things, right? So you've got to do that, but you also have to learn the other side of the equation, which is the market analysis. Which way is this market going? How far do I think it's going to go? And they're two separate streams. So start out just trading one instrument. Don't bother trying to learn shares, futures, currencies, commodities and cryptocurrencies all at once, because you're only going to be able to trade one of them anyway, probably. Don't waste your time trying to learn all those things. Spend your time learning how markets move. Something like our active trader program, which I think is the perfect start for you if you want to get into trading. It'll teach you how to identify the trend of the market, how to set your price targets, and how to trade that all with safety. And at the back of the first half of that course, you've got how to trade futures, how to short sell, how to trade CFDs and options and all these sorts of things. And you'll be able to pick one of those, but you'll also have the grounding for how to trade as well. So choose one instrument, and then let's say you've chosen shares, just choose a few individual shares and take some time to study their charts. Grab a piece of trading software. I use Profit Source software, as I said, by Hub Financial Group. Grab a piece of software like that, have a look over the history of the charts and work out, is this a market that I want to trade? Is this volatile enough for me? Is it too volatile? Am I going to be able to sleep at night if I trade this market? Okay, so choose a few. If you're going to do commodities, choose a few commodities and study their charts. Okay, and then try out your trading system on them. So whatever system that you trade, if you're a swing trader like I am, try your swing charts on them. Whatever you do, try out your trading system. See if it works. See if you can make money on that. Personally, I'm a swing trader. I use swing charts. So I like to find markets where swing charts work really well, and where I can use my swing trading skills for profits. Right? Because I'm a swing trader, I like markets that trend well. Okay, so question for you: what do you think my favorite kind of market to trade is? Right? Obviously, it's the currency markets because they trend really well. David Bowden, the founder of Safety in the Market, said that if he could only trade one thing, if that was the rule of the game, said if I could only trade one thing, it would be a currency. All right. Now, that doesn't mean that you have to start at currencies. Again, some traders I know can't stand currencies. They love the commodities, okay, because they're more volatile. Okay, currencies are a bit slower, but they tend to be more slow and plodding and trending. Some people just love their shares, and I can tell you there's more than enough opportunities just in trading shares, okay? So in terms of where should you start, that's completely up to you. Have a look at the different markets, have a look at the charts, see what suits you, make a decision and get started. And at the end of the day, as long as you start, you're going to make some progress. I started in stocks, I dabbled in commodities, and then I ended up in currencies, okay? You'll find your home, you'll find what suits your personality, and you'll jump in and you'll trade, trade what you want to trade and trade what you love to trade. All right, so thanks for watching this video. I hope that you've enjoyed it. If you'd like to see more from Safety in the Market, make sure you click on the subscribe button below and subscribe to our channel to keep up to date with all of our latest videos. And we're going to have plenty more content coming up. So thanks for watching, and I'll see you in the next video.